The most dangerous sentence in personal finance is not, "The market is down." It is, "I will make it back later." That sentence has ruined more retirements than bad stock picks ever did. When you are 30, later is a meaningful asset. When you are 60, later is a story people tell themselves because the arithmetic hurts too much to face. I want to begin there because most people do not lose their future in one dramatic moment. They lose it slowly, politely, conventionally. They lose it by following advice that sounds reasonable in ordinary times and becomes lethal when the cycle changes. I have spent a lifetime around capital. I have watched optimism get dressed up as wisdom. I have watched fear get dressed up as prudence. And I have learned that the great danger near the end of a debt heavy era is not that people become greedy. It is that they become passive. They assume the structure protecting them is stronger than it really is. They assume diversification is the same thing as defense. They assume a portfolio that survived the last decade is prepared for the next one. Very often, it is not. A few years ago, I spoke with a man I will call David. He had done nearly everything the conventional world tells a responsible person to do. He worked steadily. He saved consistently. He avoided flashy speculation for most of his life. By his late 50s, he had built a retirement nest egg that should have bought him freedom. He owned a balanced portfolio. A little more than half was in broad stock funds. A large chunk sat in bonds. The rest was sprinkled into whatever a polished advisor could describe with enough confidence. David was not reckless. He was organized. He kept statements. He reviewed his accounts. He believed that if he stayed disciplined, the system would reward him. Then the cycle turned. What had been sold to him as stability became a trap. His stocks fell hard. His bonds did not rescue him the way he had been taught they would. His supposedly sensible mix behaved like a house with 2 rooms and the same fire in both of them. In a relatively short stretch of time, years of savings shrank with a speed he had never emotionally prepared for. The number on paper was terrible. The real damage was worse. Retirement moved from a date to a question mark. The cabin he and his wife had talked about stopped being a plan and became a memory of a plan. Travel disappeared. Confidence disappeared. Sleep disappeared. The market eventually recovered in the way markets often do. His life did not recover on the same schedule. That is the part many people never understand. A portfolio can come back. A lost window cannot. If you are forced to spend 5 extra years working because your base was cut in half at the wrong moment, that is not just a financial setback. That is a life event. That is a transfer of time. And time is the one asset nobody compounds back. This is why I want to speak plainly. If your retirement plan still depends on the old assumption that a conventional stock and bond mix will carry you safely through any environment, you need to look again. I am not saying civilization is ending. I am not saying productive businesses have no future. I am not saying every market decline becomes a depression. I am saying something more useful. We are living in a period where debt has become so large, so layered, and so politically inconvenient that the usual defenses are weaker than most people think. That matters more than the daily headlines. It matters more than this quarter's earnings beat. It matters more than the smiling certainty of a person on television telling you to stay calm and hold everything exactly as it is. I do not get paid to scare you. I care about arithmetic. And the arithmetic of a debt, saturated system eventually forces a reckoning. A country can borrow for a long time. A corporation can refinance for a long time. A consumer can roll balances and extend payments for a long time. That is how cycles fool people. The stress builds gradually, then reveals itself suddenly. At first, debt feels helpful. It pulls tomorrow's spending into today. It raises asset prices. It makes households feel richer. It makes governments feel more capable. It makes investors confuse rising prices with strong foundations. Then a point arrives when the promises are too large relative to the real productive engine underneath them. That is when the game changes. At that stage, there are only a few exits. One exit is default. The borrower does not pay. The lender discovers that an asset on paper was only a hope in disguise. Another exit is restructuring. The debt is renegotiated, stretched, diluted, or partially forgiven. That sounds civilized until you realize someone still absorbs the loss. The third exit, and the most politically tempting one, is inflation. You do not openly admit the promises were too large. You make the currency smaller. You do not technically cancel the obligation. You erode the measuring stick. That is the choice governments and central banks return to again and again because it is the least immediately visible to the public. The saver feels it late. The retiree feels it late. The person holding long-duration paper claims feels it late. But they feel it. They feel it in groceries. They feel it in insurance. They feel it in health care. They feel it in housing. They feel it in the quiet humiliation of realizing that a lifetime of nominal savings buys less than expected. This is why late-stage debt cycles are so dangerous for ordinary people. The losses do not always announce themselves with a bell. Sometimes the damage comes from volatility. Sometimes it comes from repricing. Sometimes it comes from a decade of money standing still while the cost of life keeps moving. People think risk means a chart crashing. That is only one form of risk. A retiree who earns nothing real for years while living costs climb is taking a form of risk just as serious. I want you to understand another thing. History is not valuable because it repeats in costume. It is valuable because the underlying incentives repeat. When debt becomes too large, paper promises become fragile. When currency is used as the release valve, the assets that depend entirely on fixed dollars suffer. When panic and inflation arrive in the same era, conventional diversification disappoints people who have never experienced that combination. That happened in different ways across different generations. In one era, equities collapsed outright. In another, stocks moved, but purchasing power went nowhere. In another, supposedly safe bonds turned into silent destroyers of real wealth. The labels change. The mechanism stays familiar. Too much debt, too much confidence in paper, too little respect for purchasing power. That combination has a long history. I know many people do not like hearing this because it sounds severe, but severity ignored becomes pain extended. I would rather be blunt early than comforting late. There was another woman who once wrote to me after a major market break. I will call her Ellen. She and her husband had been careful all their lives. Not brilliant, not aggressive, just careful. They saved. They avoided obvious foolishness. They trusted professionals. And when the downturn came, it did not merely cut the value of their accounts. It moved into their home. Her husband became consumed by the numbers. He woke up at night to check balances. He stopped eating normally. He stopped speaking about the future because he no longer believed the future they had planned still existed. What people call financial stress is often described too lightly. It is not merely worry. It is a corrosion of peace. Ellen told me that if she could relive those years, she would trade a portion of the upside they had been promised for a portfolio that would have let them sleep. That sentence has stayed with me. A lot of investors talk as if the highest return is always the highest goal. It is not. The right goal depends on where you are in life. If you are near the stage where money must serve you instead of merely grow for you, resilience matters more than brilliance. Survival matters more than excitement. Durability matters more than theoretical optimization. So if I were helping someone rebuild a retirement portfolio for a world shaped by debt stress, sticky inflation risk, and violent repricing, I would not begin with a forecast. I would begin with a question. Which assets still protect you when paper promises stop behaving like promises? I come back to 4 broad categories, not 40, not 1,000 ticker symbols, disguised as complexity. 4 categories. They are not glamorous. They are not designed for cocktail party bragging. They are designed to survive conditions that ruin conventional portfolios. The first is short-term government paper and genuine cash reserves. That may sound strange to hear first because people love big return stories. But optionality is one of the most underappreciated assets in the world. When panic arrives, the person with liquidity is not cornered. The person with liquidity can act. The person with liquidity does not have to sell quality assets into weakness in order to meet expenses. The person with liquidity can buy while others are trapped. That is not a small advantage. That is one of the greatest advantages in all of investing. I have always liked having more cash than fashionable investors think is necessary. Cash is never exciting in a roaring market. It can even make you look foolish for a while. But when conditions tighten, when credit contracts, when prices break faster than confidence can adjust, cash stops looking lazy and starts looking intelligent. I am not talking about cash scattered thoughtlessly in places earning nothing. I am talking about short-duration treasury exposure, high-quality money market reserves backed by government securities, and a maturity structure that gives you access, safety, and flexibility. Why short-term? Because long maturity paper is a different animal. When inflation expectations shift or rates rise, long bonds can punish you badly. A long promise in a weak currency regime is not a safe asset, just because it comes in a conservative wrapper. Short-term paper is different. It is not there to make you rich. It is there to preserve maneuverability. It is dry powder. It is emotional stability. It is the difference between being forced and being free. In a stressed world, I would want a meaningful allocation there, enough to cover living needs, enough to let me take advantage of distress, enough to keep me from becoming a seller at exactly the wrong time. The second category is ownership in businesses with real pricing power. I want to be very clear here. I am not saying every stock belongs in the safe bucket, far from it. A stock is just a label. What matters is the underlying business. Can it raise prices without losing its customer base? Does it sell something people still need when times are hard? Does it generate real cash instead of promising future greatness? Does it own brands, networks, resources, regulated structures, or intellectual property that help it protect margins when the currency is losing credibility? That is what I mean by pricing power. In a benign period, weak businesses can hide. In an inflationary or debt-stressed period, weak businesses get exposed. Their costs rise, their debt hurts them, their customers disappear, their dreams become accounting problems. Strong businesses behave differently. A company selling essential consumer staples can often pass higher input costs along because households still need what it sells. A utility with a durable framework can maintain economic logic even when costs rise. A healthcare company selling products that patients and hospitals cannot easily postpone has a different kind of resilience than a fashionable business selling desire rather than need. An energy or infrastructure business tied to the real economy may be unpleasantly cyclical at times. But if it owns assets the world cannot simply wish away, it can protect value better than people expect. This is why I would rather own a handful of understandable businesses with durable economics than a giant pile of paper claims whose only real virtue is that they are popular. Index funds have their place. I have said many times that for many people they remain a sensible tool, but a late cycle defensive posture is not the same thing as a lifetime accumulation plan for a young worker. Context matters. If you need defense, you should know what you own and why it belongs there. Pricing power is not a slogan. It is one of the few real shields a business has when the unit of account is wobbling. The third category is physical precious metal, owned as insurance, not worshipped as religion. I do not spend my life romanticizing metal. A productive business is usually my first love. But history is clear on one point. When trust in money deteriorates, people eventually rediscover that an asset with no counterparty risk has a role. The reason to own physical gold, and to a smaller extent, silver, is not because they produce cash flow. They do not. The reason is that they sit outside the promise structure. They are not somebody else's liability. They do not depend on the goodwill of a board, a bank, a finance ministry, or a refinancing window, in long, calm stretches that can make them look dull. Good insurance is supposed to look dull before the fire. The mistake people make is buying paper substitutes and believing they own the same thing. In a real stress environment, structure matters. Direct ownership matters, access matters, simplicity matters. You want bullion, not a clever story. You want allocation, not obsession. You want enough that it matters in a currency accident, but not so much that your entire future depends on one non-productive asset carrying the whole load. The way I think about it is straightforward. If the monetary authorities do what authorities have so often done when overwhelmed by debt, they will sacrifice the purchasing power of the unit rather than allow the burden of the promises to crush the entire system all at once. In that world, metal is not there to outperform every year. It is there to refuse participation in the debasement. That is a different job, and it is a valuable one. The fourth category is productive real assets. By that, I mean things tied to actual human necessity. Farmland, select rental real estate, infrastructure connected to essential activity, assets that produce food, shelter, throughput, utility, or contractual income from things society cannot stop using. The beauty of real assets is not that they never fluctuate. They do. The beauty is that they remain linked to reality. You cannot print farmland. You cannot conjure useful housing out of thin air. You cannot manufacture scarcity away in sectors where real-world supply takes time, labor, land, and capital to create. When paper claims are being repriced, tangible productive assets regain respect. That does not mean every property deal is smart. A poorly financed real estate purchase can be a disaster. A speculative office tower bought with bad assumptions is not my idea of safety. What I am talking about is disciplined exposure to productive assets whose usefulness survives policy mistakes. For many investors, that means carefully chosen real estate investment trusts. For others, it may mean direct ownership if they have the experience, balance sheet, and patience. For a few, farmland exposure can make sense. The principle is what matters. Own some claim on reality itself, not just on abstract valuation multiples. Now, let me pause and say something important. This is not a call to panic. A lot of people hear a late cycle warning and make the wrong move. They think the answer is to hit the eject button on everything. Dump assets all at once and sit in emotional paralysis waiting for disaster. That is not discipline, that is theater. Good defense is systematic, it is calm, it is proportional. It recognizes that nobody rings a bell at the top. Nobody hands you a perfect calendar for when confidence breaks. All you can do is respond to the structure in front of you. And the structure today tells me this much. The window to reposition is probably measured in quarters, not in carefree decades. Maybe it is 18 months. Maybe it is a little more. Maybe it is less. I do not pretend to know the exact month. I do know that when debt loads become this heavy, when interest costs become this politically important, when every solution points back toward easier money and weaker purchasing power, the luxury of complacency gets expensive. So how would I act? First, I would stop pretending every asset deserves to be kept out of loyalty. Many people cling to positions because selling feels like admitting they made a mistake. That is pride disguised as patience. If you own speculative garbage, sell the garbage first. If you own a business you cannot explain, ask yourself why it is there. If you own assets that only worked because money was cheap and optimism was infinite, understand the environment those assets require, then ask whether that environment is becoming more or less likely. Second, I would separate my portfolio into functions. Some capital must preserve immediate safety and flexibility. That belongs in the short duration liquidity bucket. Some capital must maintain purchasing power through ownership of resilient businesses. That belongs in the pricing power bucket. Some capital must stand outside the promise machine. That belongs in physical precious metal. Some capital must remain tied to real-world productive necessity. That belongs in real assets. When you think in functions, portfolio construction becomes clearer. You stop asking, what is hot? You start asking, what job does this asset perform when things get ugly? That is a far better question. Third, I would build the posture over months. Not in one dramatic afternoon. A person 10 years from retirement does not need to move with the same urgency as a person 2 years away. Time horizon matters, cash needs matter, temperament matters, but gradual action is usually better than waiting for certainty. Certainty is a luxury investors almost never receive until the price of action has become painfully obvious. This is where many people freeze. They want proof. They want the crisis to become undeniable before they reposition. That instinct feels rational. In practice, it is usually expensive. By the time the evidence satisfies everyone, the repricing is already underway. The bargains for prepared people exist because unprepared people are being forced to act. By definition, happens before consensus. Fourth, I would ignore the ego game. In strong markets, defensive positioning can feel lonely. Your neighbor will brag about returns. Financial media will celebrate every new high. Someone with leverage will look like a genius for a while. Let them. The goal is not to win a 6-month popularity contest. The goal is to preserve enough capital and enough emotional control to still have choices when the environment changes. That is a much bigger victory. I also want to say something about advisors. There are good ones, there are thoughtful ones, there are honest ones. But incentives matter everywhere. Many people are paid to keep you in products. Many are paid to maintain activity and confidence. Very few are paid to tell you that owning a little less complexity, a little more liquidity, some direct bullion, and some real assets might do more for your peace of mind than another glossy allocation model. So you must think for yourself. You must ask better questions, not what has done best lately, not what does everyone else own ask. If inflation stays stubborn, if debt policy gets uglier, if markets reprice hard, what in my portfolio still makes sense? That question cuts through a lot of nonsense. People also misunderstand the mathematics of recovery. A 50% decline requires a 100% gain just to get back to even. That is true on paper. In real life, the recovery requirement is worse because time passes, inflation keeps moving, and withdrawals may begin. This is why big drawdowns near retirement are not inconveniences. They are structural breaks. Avoiding them matters more than squeezing out the last bit of upside in the final euphoric stage of a cycle. I would rather give up part of a late bull market than spend the next decade trying to rebuild from a hole. That may not sound glamorous. It sounds intelligent to me. If you ask me for a rough shape, I would think in ranges, not rigid precision. A meaningful slice in short-term treasury reserves and true liquidity. A larger slice in businesses with durable pricing power and understandable economics. A measured allocation to physical gold and some silver as monetary insurance. Another measured allocation to productive real assets. The exact percentages depend on age, obligations, income sources, tax considerations, and temperament. But the principle is stable. Your core should be built for survival first. Opportunity comes later. In fact, survival creates opportunity. That is the irony most aggressive investors miss. When the cycle breaks, the people who preserve capital become the people who can buy extraordinary assets on favorable terms. That is when liquidity and discipline turn from boring virtues into wealth, creating advantages. I have seen it too many times to doubt it. During moments of panic, wonderful assets get sold by people who simply cannot hold them any longer. They may be overleveraged. They may need cash. They may be emotionally broken. They may be institutions forced by rules to liquidate. The prepared buyer meets that moment with calm because the prepared buyer kept reserves. That is why defense and offense are not opposites. Good defense creates the conditions for intelligent offense. If you think that way, repositioning stops feeling like surrender. It starts feeling like maturity. It starts feeling like respect for your own future. And that brings me back to where I began. The greatest mistake near the end of a dangerous cycle is not ignorance. It is delay. It is hearing the logic, feeling the truth of it, and then promising yourself you will deal with it later. Later is how people become trapped. Later is how people end up holding the wrong assets through the wrong environment at the wrong stage of life. later is how a 5-year retirement delay gets born. Do not do that to yourself. Open your accounts. Look at them without nostalgia, without excuses, without the comforting language of the last cycle. Ask what each holding will do if purchasing power matters more than nominal headlines. Ask whether it protects, produces, or merely promises. If it merely promises, be careful. If it depends on cheap money, be careful if it cannot pass inflation through. Be careful if it has no role in a stressed world, be honest. Then make a plan, not a fantasy. A plan. What leaves first, what you trim next, what you add to build liquidity, which businesses truly belong in the durable bucket, how you will own a little monetary insurance, what form of productive real assets makes sense for you. Write it down. Dates matter, structure matters, emotion is unreliable under pressure. A written plan is often the difference between acting and drifting is deadly in moments like this. I am not asking you to predict the exact week the crowd wakes up. I am asking you to respect the phase we are in. Every long cycle teaches the same lesson in different language. Leverage feels intelligent on the way up. Liquidity feels foolish until the day it becomes priceless. Paper wealth feels permanent until inflation, panic, or both arrive together. Simple assets tied to reality. Look old-fashioned until old-fashioned becomes the only thing standing. That is not a fashionable message. It is still true. If I were rebuilding a retirement portfolio in a world like this, I would want less dependence on optimism and more dependence on structure. I would want fewer assumptions. I would want more resilience. I would want the kind of allocation that lets me sleep, act, and endure. Because once you understand the arithmetic, the mission becomes obvious. Protect the base, preserve purchasing power, hold optionality. Own a piece of reality, then, when the crowd is forced to relearn lessons it forgot, you will not be among the casualties. You will be one of the few people with both capital and composure. And capital plus composure is an extraordinary combination. That is how you protect a retirement. That is how you protect your time. That is how you avoid waking up one day with a haunting realization that the market did not merely take money from you. It took years. Do the work before the panic does it for you. Do it while the choice is still yours. Do it while the window is still open. Because the people who act early usually look overly cautious right before they look wise. And I would much rather look cautious for a while than helpless when it matters.